Welcome back to the Pro Ticker Podcast, your Friday morning edition covering major financial magazine headlines, everyone. This is the deep dive where we take a stack of the latest insights, research, and reports and really unpack the most important nuggets of knowledge for you. Our mission is basically to give you a shortcut to being well informed, hopefully with those surprising facts and aha moments that, actually stick. Today, we're plunging into a fascinating collection of reports. Got stuff here from CNBC, Bloomberg, Reuters, all hitting the wires today, Friday, July 25th, 2025. We've got our eyes on, well, everything: global trade talks, central bank moves, big corporate earnings, and of course, the ever-shifting tech and crypto landscapes. It's definitely a packed day.
It certainly is a dynamic financial picture. And what's really fascinating, I think, is how interconnected these things are. Headlines that seem separate, they're usually not. You see a trade deal, maybe like the one just announced, and you think, okay, that affects that industry. But as we'll get into, it ripples out. It affects global consumption, central bank decisions, even how major companies strategize. We'll be connecting those dots today, helping you understand not just what's happening, but why it matters for the bigger economic picture. So, yeah, let's unpack this. The intertwined world of trade and global economics.
Okay, let's dive straight in then. The big story shaping markets everywhere: trade. We've seen a real flurry of activity, especially out of Washington. Some clear winners, and maybe some others struggling.
Indeed. The U.S. just finalized a trade framework with Japan. President Trump hailed it as massive. We saw that reported across CNBC and Reuters. Basically, the U.S. puts a 15% tariff on most Japanese imports, cars included, and Japan, in return, creates this huge $550 billion fund for U.S. investments. It's not just about Japan, though. This sets a significant precedent, almost like a new template, for how the U.S. might approach other talks. It's very specific, sort of managed trade.
Right, a template. So Japan's deal is done. What's next? Is the EU really lining up for a deal like some reports suggest? And if that happens, what does it mean for countries like South Korea? They seem to be having a tougher time, don't they?
Yeah, that raises a really important question about the dynamics here. Diplomatic leverage, negotiation tactics. As Bloomberg reported, South Korea's leader, Lee Jae-myung, he's facing a tough early test. His negotiators are frankly struggling, especially with those higher U.S. levies, 25%, jumping up from 10%, set to kick in next week. That's a big deal. South Korea's economy is incredibly reliant on exports. I mean, over 40% of their GDP in 2024 was overseas shipments. And those canceled high-level meetings, their national security advisor with Secretary of State Rubio, their finance minister with Treasury Secretary Bessent, pulled at the last minute. That really underlines their difficult spot. It's a stark contrast to how quickly Japan, Philippines, Indonesia, Vietnam got deals done. Maybe a shift in priorities or even a strategic message from D.C.
Okay, so some get deals, others struggle. But bottom line, what does this mean for, us, for consumers, and the global economy overall?
Well, while these deals might slightly lower some tariffs, analysts like Eastspring Investments, they're cited pretty widely, they suggest companies are much more likely to just pass these costs on to consumers. So it's not just about pricier imports potentially. It could really weigh on a key source of U.S. growth, which is consumption. They actually expect U.S. GDP growth to slow, maybe down to around 1.6% year over year by the end of 2025. And that slowdown, if it happens, isn't just a U.S. issue. It signals caution, maybe a broader global deceleration driven by this trade friction, which naturally hits global exporters hard.
And speaking of hitting hard, reports from Reuters suggest Eurozone companies are already feeling it. Trade tensions and more competition from China. Sounds like a double whammy.
That's absolutely right. There was a recent European Central Bank poll, the ECB poll, done late June, early July. It showed companies reporting a noticeable slowdown in activity. That lines up with forecasts for pretty modest growth in Q2 and Q3. The U.S. tariffs are a clear negative, yeah. But what's also interesting is this increasing role of Chinese competition, specifically through trade diversion. Basically, goods that might have gone elsewhere are now flooding into Europe, creating new pressures. So far, it's mostly hit intermediate goods, components, materials. Not much impact on final consumer prices yet, but the expectation is this effect will broaden, eventually hitting more goods and, the consumer too. Market pulse. Central banks, stocks, and bubble concerns.
Right, so Europe's dealing with trade fallout, slowing activity, makes the ECB's moves even more crucial. They just held rates steady at 2%, didn't they, after 8 straight cuts since June 24. What are the big banks saying about that, this wait-and-watch approach?
It is very much a wait-and-watch situation, exactly as ECB President Lagarde put it. Reuters picked up on that phrasing. And what's significant is how the consensus among major banks is shifting. Goldman Sachs. They now expect no further ECB cuts this year. That's a change. JP Morgan also pushed their forecast back from September to October for a cut. Others, like Bank of America, Morgan Stanley, they still see September maybe, but they admit there are risks. If the economic data comes in stronger, maybe no cut then either. And the money markets, they reflect that uncertainty. Only about a 30% chance priced in for a rate cut below 2% by year end. So the market's hesitant too.
Okay, meanwhile, over here in the U.S., despite all this talk, trade tensions, potential slowdowns, the S&P 500 and NASDAQ just hit fresh record closes on Thursday. That's the 13th for the S&P, 14th for the NASDAQ this year, both way up year to date. CNBC reported that. But wait, you mentioned earlier, even with strong U.S. economic data, Treasuries struggled today. That feels backward. What's going on there?
That's a sharp observation. It really highlights a key tension, doesn't it? You're right. U.S. Treasuries, normally a safe haven, they struggle today. And this is despite good U.S. data. Jobless claims fell again 6 weeks straight. Flash PMIs, those manufacturing and service indicators, were better than expected. Composite reading at a 7-month high, 54.6. Pretty strong. So why the disconnect? Probably a few things. Strong data makes safe havens like Treasuries less attractive. Investors look for higher returns elsewhere. Plus, there's always speculation about the Fed. Maybe strong data means no rate cuts anytime soon. It just shows a market kind of wrestling with conflicting signals. Strong domestic growth versus these global trade headwinds.
And this strong market run, hitting records, it always brings up the bubble warnings, doesn't it? Tell us about Michael Hartnett at Bank of America. His cautions seem to be getting louder.
Oh, absolutely. Hartnett is sounding the alarm again. Bloomberg's been covering this. He points to a couple of key things. First, monetary policy loosening globally. That world policy rate, the average central bank rate, has dropped significantly, and it's forecast to drop further. Easy money, basically. Second, he's watching policymakers potentially changing rules to get more retail investors involved. He famously summed it up. Bigger retail, bigger liquidity, bigger volatility, bigger bubble.
And he has a track record, right? He correctly called international stocks beating the U.S. this year. His warning back in December 2024 came just before an 18% dip in the S&P. So yeah, people listen when he talks.
Okay, so it sounds like a really strong debate then. What's the core disagreement? Are there solid arguments against Hartnett's bearish view? Why are some still bullish? Absolutely, it's a vigorous debate. You've got folks like Michael Wilson at Morgan Stanley who remain bullish. They point to positive earnings momentum, the idea that corporate profits can keep justifying these high valuations. But then you have strategists at JP Morgan, at UBS, warning the market's getting complacent, ignoring the lingering trade risks. They argue, yeah, the U.S. picture might look okay, but global friction could still derail things. So it's kind of Bull camp says earnings will hold up. Cautious camp says geopolitics and trade are too risky. That Federal Reserve meeting next week, absolutely crucial. We need clues on their path, how they're weighing these conflicting signals. 3, corporate giants and sector spotlights.
Right. So with these big economic pressures, bubble warnings, the focus really sharpens on individual companies, doesn't it? How are the giants holding up? Let's shift gears. Some major corporate headlines. Intel's Q2 earnings dropped after the bell yesterday. What's the story there?
Yeah, Intel. They actually beat on revenue, $12.8 billion versus $11.8 billion expected. Sounds good, right? But they missed on adjusted earnings per share. Why? Significant impairment charges, big accounting write-downs, not a good sign. And the really big news, picked up by CNBC, Yahoo Finance, they're cutting headcount by 15%, aiming for about 75,000 employees by year-end. And they've canceled those planned factories in Germany and Poland. Their stock dropped almost 5% in pre-market today.
Oof, that's a tough announcement. But is this just Intel struggling, or does it say something broader about competing with NVIDIA in the AI chip space right now? It seems brutal.
That's a critical question. I mean, some of Intel's problems are specific to them. Manufacturing delays, product focus shifts, things like that. But it absolutely highlights the sheer capital intensity, the razor-thin margins in this AI chip race. It's incredibly tough. Intel faces more competition from AMD, from Qualcomm too, especially with Qualcomm pushing Snapdragon X into PCs. So yeah, it's partly Intel's issues, but it's also a stark reminder even giants have to make painful pivots. It might signal a future where only a very few companies, massive capital, cutting-edge tech, flawless execution could really thrive in AI hardware. NVIDIA, obviously, market cap over $4 trillion. They're the behemoths right now. Underscores that winner-take-all dynamic Jim Cramer talks about on CNBC. Cramer actually thinks big tech Meta, Amazon, Alphabet, Microsoft are underspending on AI, even though they plan like $320 billion combined for 2025. He argues companies like Alphabet, who just beat earnings and added another $10 billion for AI infrastructure, they have to spend big. It's a winner-take-all, loser-take-none game, he says.
Wow. Speaking of big tech, maybe unconventional plays, Tesla's Q2 earnings. Another fascinating story there, especially on their Bitcoin holdings. CNBC highlighted this. Feels like a massive missed opportunity looking back, doesn't it?
Oh, definitely interesting. And yes, a significant strategic fumble, you could say. Tesla missed on top and bottom lines for Q2. Stock plunged 8% yesterday. But digging deeper, that Bitcoin story. They sold 75% of their holdings back in mid-2022. Bitcoin was trading way lower then. Since then, Bitcoin's rebounded sharply. Near a record now, over $119,000, up about 80% in the past year alone, partly helped by the Trump administration trying to loosen crypto regs, giving it more perceived legitimacy, perhaps. Point is, if Tesla had held on to all its Bitcoin, that stash would be worth roughly $5 billion today. Instead, they hold about $1.24 billion. Ouch.
And that kind of resonates with other crypto strategies we're seeing, right? Suggests as a broader trend, maybe.
Yes, it does. Like Bloomberg reported, Michael Saylor's company, now cleverly called Strategy, just raised $2.8 billion. They use a new security called Stretch, offers a hefty 9% annual payout. And what's the money for? Buying more Bitcoin. It's not just one company's wild bet anymore. It reflects a broader, maybe speculative fervor, but also the rise of companies focused solely on holding crypto. Suggests growing institutional interest, maybe a slow normalization of crypto as an asset class, albeit a very volatile one.
Okay, so beyond the giants like Intel and Tesla, we're also seeing some really notable movers in specific sectors. What's driving some of these standouts?
Absolutely. It's not just about the household names. Seeing some fascinating trends looking across various CNBC reports. European financials, for instance. They're not just up, they've surged about 40% year to date. That's the iShares MSCI Europe Financials ETF. Major banks like Commerzbank doubled. Maybe signals recovering confidence in the Eurozone? Or maybe just relief the ECB isn't cutting rates too aggressively. The space sector, too, really taking off. Firefly planning an IPO. Rocket Lab up 88% year to date. AST SpaceMobile soaring 185%. That's driven by satellite demand, the private space race, new connectivity applications. Lots going on there. Materials sector. Newmont up 65% year to date, hit a record this week, probably riding commodity price trends. And we're seeing strong earnings beats from individual companies too. Deckers, Boston Beer, Comfort Systems USA, Coursera. Shows good companies can still shine.
And quickly, Asia markets, mostly down today. But were there any bright spots amidst those trade tensions we talked about?
Yeah, despite broader declines, Nikkei 225 down, Hang Seng down, South Korea's Kosdaq actually bucked the trend. Edged up slightly today, maybe some resilience despite trade worries. And Vietnamese equities hit a fresh record high over 3 years, up 0.5% today. Strong domestic story there, it seems. On a less positive note, we also saw reports about that escalating border conflict between Thailand and Cambodia. That could really hurt their tourism economies, especially Cambodia, which relies heavily on it. Forfeit the Fed in the political crosshairs.
Okay, let's shift to something really unprecedented this week. President Trump visiting the Federal Reserve. This wasn't just a casual drop-in, was it? Felt more like a direct, very public challenge?
Far from casual, yes. Only the fourth time a president has visited since 1937. And critically, the first time while a president was openly pushing for specific monetary policy changes. The public flashpoint, surprisingly, was the cost of the Fed's building renovations. Trump claimed over $3.1 billion. Chairman Powell publicly corrected him almost in real time. Powell said Trump was including another government building finished years ago. The Fed's actual project on 2 buildings, $2.5 billion. That very public back and forth just caused the tension.
Right. So on the surface, arguing about renovation costs, but what was the real agenda here? What does this confrontation tell us about the White House and Fed relationship now?
Well, Trump's objectives seem pretty clear. Pressure Powell to lower interest rates. He said it again. I'd love him to lower interest rates. Claimed it would save the U.S. hundreds of billions. He noted interest payments on U.S. debt topped $1.1 trillion last year. That's a huge number. Now, Trump did back off earlier threats to actually fire Powell, said it was highly unlikely, not necessary. But the pressure campaign continues. From his administration, allies, calls for an exhaustive internal review of the Fed by Treasury Secretary Bessent, talk of congressional investigations. It's intense. It's not just policy disagreement. It feels like a public power play.
Which brings up that huge question about Fed independence. We kind of take it for granted, but how protected is it really? When the political pressure is this open, this direct?
That is the absolute crux of it. On one hand, the Supreme Court recently signaled that the Fed's independence is protected by legal precedent. That's a strong legal shield. But this visit, this ongoing public pressure campaign, it's unprecedented in its directness, its visibility. It creates this tension between the law and political reality. The Fed, for its part, they've defended the renovation costs, cited security upgrades, rising material costs, finding asbestos, toxic soil, unforeseen stuff. But the underlying message of that visit goes way beyond construction budgets. It's fundamentally about who controls the levers of monetary policy. Outro.
Wow. Okay, we have covered a lot of ground today, from, those high-stakes global trade talks, the subtle signals from central banks, to the fierce battles in tech, the wild ride of crypto. It's just so clear how interconnected everything is in the financial world. Seemingly small events can ripple out in big ways.
Absolutely. If you step back and connect the dots, it really underscores how fast economic narratives can shift, influenced by everything: geopolitics, tech breakthroughs, even, as we saw, very public political pressure. Understanding these underlying currents, seeing how each piece of news fits into the bigger story, that's really key to making sense of the headlines day to day.
So what does this all mean for you listening? Given these clashing predictions on market bubbles, the dynamic and sometimes surprising role of retail investors, and that aggressive spending we see in areas like AI, how might you rethink your own approach to evaluating market signals, especially when political pressures on supposedly independent institutions are so, well, openly on display? Definitely a lot to mull over. Thank you for joining us on this deep dive. We hope this has given you a clearer, maybe more comprehensive understanding of the forces shaping our financial landscape today. We'll see you all Monday morning with new headlines from major financial magazines.